The dark days of the great financial crisis are safely behind us. The system is fundamentally stronger than it was back then, and the reckless lending practices of the past are no more. Well, no, not exactly. In the more shadowy corners of Wall Street, major banking institutions are loading up the exact same financial weapons that were used to bet against the housing market in 2008. This time, however, they are not targeting subprime mortgages, but rather a $3 trillion shadow banking system where default rates have already surpassed the peak levels recorded in 2008. Today, we reveal why a massive shorting machine built specifically for the private credit market is flashing a warning sign for the global economy. My name is DC, and you're watching The Coin Bureau. Following the 2008 financial crisis, sweeping regulatory reforms fundamentally reshaped the architecture of corporate lending in the United States and across the developed world. The Dodd-Frank Act and Basel III capital requirements dramatically increased the cost for traditional banks to hold leveraged corporate loans on their balance sheet, making middle market lending economically unviable for the established banking system. This regulatory retreat created a vacuum at the very base of the corporate financing pyramid, and that vacuum was rapidly filled by asset managers and private equity firms operating entirely outside of the regulated banking sector. These private lenders began issuing trillions and trillions of dollars in loans directly to mid-sized companies, bypassing the traditional banking system and all of the transparency requirements that come with it. The industry that emerged from this regulatory gap is known as private credit, and it has exploded from a $40 billion niche in the year 2000 to approximately $3 trillion as of early 2025. A 15-fold increase in just 15 years. And to understand exactly why this growth represents a systemic danger, you have to look at the specific structural characteristics that define these loans. Because these lending arrangements are entirely private, they lack the standardized credit rating systems, the daily mark-to-market price discovery, and the secondary market liquidity that exist in the public corporate bond market. To put it simply, these loans are valued using internal models built by the exact same fund managers who originated the loans and who collect management fees based on the total value of their assets under management. You see, when the entity responsible for assigning a value to an asset is the same entity that profits from that value being high, you have created a structural incentive to overstate the health of the portfolio. As of the first quarter 2025, direct lending loans were still being marked at 98.7% of their original face value, despite surging defaults and collapsing profitability metrics across the underlying borrower base. Furthermore, Bank of America strategists have explicitly characterized this entire asset class as the lowest quality segment within the leveraged finance sector. This is the shadow banking system operating at a massive scale with virtually no external oversight, and it is precisely the kind of opaque, interconnected financial architecture that regulators failed to monitor before the last crisis. Now, you might assume that even if this lending sector carries elevated risk, the borrowing companies themselves would simply adjust their business models to manage the additional debt burden. However, that assumption completely ignores the specific financial engineering embedded into the structure of these loans, because the entire private credit boom was constructed on a foundation of floating interest rates during an era of effectively 0% monetary policy. Unlike traditional fixed-rate corporate bonds, where the interest payment remains constant for the life of the instrument, the vast majority of private credit loans carry floating rates tied directly to the Federal Reserve's benchmark through a reference rate known as SOFR. This means that every single basis point increase in central bank policy rates flows directly and immediately into the debt servicing costs of these mid-sized corporate borrowers. For a typical mid-market borrower with a private credit loan priced at SOFR plus 550 basis points, the all-in interest rate exploded from approximately 5.5% in 2021 to nearly 10.8% at the peak of the hiking cycle. For a company carrying $100 million in outstanding debt, this represents the difference between $5.5 million and nearly $11 million in annual interest expense, effectively doubling the cost of capital in a matter of months. The devastating consequence of this rate shock is visible in the collapse of interest coverage ratios across the entire private credit borrower universe. The average interest coverage ratio, which measures a company's ability to pay its interest obligations from operating income, has plummeted from 3.2 times in 2021 to approximately 1.5 times as of recent months. The proportion of borrowers with coverage ratios below that critical 1.5 threshold has surged to 47% compared to just 7% in the fourth quarter of 2020. And the International Monetary Fund recently reported that 40% of private credit borrowers had negative fee operating cash flow at the start of 2026, meaning these companies cannot generate enough cash from their operations to cover even the interest payments on their outstanding obligations. This creates a situation where companies that were highly profitable under zero-rate conditions are now suffocating under compounding interest expenses that their revenue models were never designed to sustain. And the most alarming indicator of this suffocation is the explosive growth of what the industry calls payment-in-kind lending, where borrowers who cannot afford to make cash interest payments instead capitalize that interest directly onto their principal balance, effectively paying debt with more debt. The share of these distress-driven amendments surged to 57.2% of all payment-in-kind activity by the third quarter of 2025. Compared to just 36.7% in 2021, confirming that the majority of this zombie lending is now driven by genuine financial distress rather than structural planning. And speaking of staying ahead of these regulatory and structural developments before they reshape your portfolio, this is exactly why you need the Coin Bureau Telegram channel. It's where we share the latest breaking news, provide deep dive alpha, and give you the most important market updates, all pinged directly to your device so you don't miss a thing. Whether it's an institutional compliance move that changes the DeFi landscape or a regulatory signal that the rest of the market hasn't priced in yet. Sign up today using the link below or by scanning the QR code on the screen right now. Okay, here is where the direct parallel to 2008 becomes impossible to dismiss. The major institutions on Wall Street are not ignoring this deterioration in the private credit market, and they are certainly not waiting for it to resolve itself. They are instead actively building the infrastructure to profit from the collapse. In April 2026, Goldman Sachs, Bank of America, Barclays, JP Morgan Chase, and Deutsche Bank partnered with S&P Global to launch the CDX Financials Index, also known as Findex, which is the first credit default swap index explicitly linked to the private credit sector through exposure to business development companies. A credit default swap functions essentially as an insurance policy on the creditworthiness of a referenced entity, so where the buyer pays a periodic premium and receives a massive payout if that entity defaults or suffers a credit event. This is precisely the mechanism that Michael Burry and the other investors immortalized in The Big Short used to bet against the subprime mortgage market beginning in 2026, purchasing credit default swap contracts on mortgage-backed securities before those securities collapsed. The structural mirror is extraordinary because the ABX index that enabled the 2008 short was launched in January 2006 by Market, which is now part of the S&P Global, the exact same institution that has partnered with these banks to launch the new private credit equivalent. Wall Street does not invest millions of dollars constructing complex derivative infrastructure for sectors they consider healthy and well-functioning. They build these instruments when they have identified a credible, non-trivial probability of systemic deterioration, significant enough to hedge against it at scale. And the evidence supporting their assessment is already visible across the entire institutional landscape. Fitch Ratings reported that the private credit default rate within their privately monitored portfolio reached 9.2% in 2025, a figure that surpasses the 6.5% peak recorded during the 2008 financial crisis itself. Meanwhile, Moody's has downgraded its outlook on the entire United States business development company sector from stable to negative, and Morgan Stanley analysts are projecting annual defaults could reach 8% between the second half of 2026 and the first half of 2027. The cracks in this facade are not theoretical projections sitting in analyst reports waiting to be validated, because the first quarter of 2026 produced the most concrete evidence that institutional investors are already running for the exits. Total individual investor withdrawal demands from major private credit firms exceeded $21 billion in a single quarter. Blue Owl Capital faced redemption requests of 21.9% of fund value and was forced to permanently halt all redemptions. The Carlyle Group's tactical private credit fund received requests to withdraw 15.7% of outstanding shares but could only honor 5% on its quarterly redemption cap. And Blackstone's $82 billion BCRED fund received $3.7 billion in withdrawal requests and posted its first monthly loss in over 3 years, forcing the firm to inject $400 million of its own capital to honor redemptions and signal confidence. This gating mechanism, where funds restrict the percentage of capital that investors can withdraw per quarter, creates a devastating self-reinforcing feedback loop. Now, when a fund announces redemption restrictions, it confirms the illiquidity of the underlying assets, which triggers additional withdrawal requests from the remaining investors. Managers must then choose between selling loan assets at severely distressed prices or imposing even tighter withdrawal restrictions. Asset sales at distressed prices cause the reported value of the fund to decline, further eroding the holdings of every remaining investor and accelerating the spiral of capital flight. The prominent economist Mohamed El-Erian has directly compared this freezing of private credit redemptions to the liquidity crisis that preceded the Great Financial Crisis. You might assume that even if the private credit market experiences a severe dislocation, the damage would remain contained within those specific funds and their corporate borrowers without spreading to the broader financial system. That assumption, however, entirely ignores the deep interconnections between the shadow lending system and the regulated banking sector that the mainstream financial media continues to overlook. United States commercial bank loans to non-bank financial intermediaries, the category that includes private credit funds, reached $1.92 trillion as of March 2026, representing a 65.9% increase since the end of 2024. Banks have lent nearly $300 billion directly to private credit providers as back leverage, meaning the regulated bank system is financing the very shadow lending operations that exist outside its regulatory parameter. This creates the classic macroeconomic transmission channel where distress in the unregulated sector flows directly back into the balance sheets of those institutions that the Federal Reserve is mandated to protect. If private credit fund collateral values are marked down, the banks that lend against that collateral face rising credit risk on their own books and respond by tightening lending standards across the entire economy. And for holders of Bitcoin and risk assets, the contagion pathway is devastatingly direct. Institutional investors, including pension funds, insurance companies, and endowments, now hold private credit alongside equities and digital assets within the same portfolio allocation frameworks. 94% of institutional investors currently allocate to private credit, and global institutional allocations to private markets reached a record 12.5% of total portfolios in 2025. So when these institutions face losses in their illiquid private credit holdings, they cannot sell the loans, so they are forced to liquidate whatever assets they can sell to meet margin calls and redemption demands. That means public equities, treasury bonds, and increasingly Bitcoin and other digital assets available through spot exchange traded funds. And this is the identical forced selling dynamic that produced the 50% crash in Bitcoin during the March 2020 liquidity crisis, when institutional investors liquidated everything regardless of fundamental conviction simply because they needed cash. The disruption to the safe haven narrative would be temporary because the historical pattern demonstrates that every systemic deleveraging event of this magnitude ultimately forces the Federal Reserve's hand. The central bank has already demonstrated its willingness to intervene, having cut rates by 150 basis points between September and December of 2024 in response to leveraged borrower distress. The Fed has also deployed targeted liquidity injections through its standing repo facility, including a $74.6 billion operation in early January 2026, that some analysts have characterized as disguised quantitative easing. With over $1.9 trillion in bank exposure to the shadow lending system, the Federal Reserve cannot simply allow a private credit collapse to transmit into the regulated banking sector without mounting an emergency response. And that emergency response, whether through aggressive rate cuts, balance sheet expansions, or formal quantitative easing, would represent the exact type of fiat liquidity injection that has historically ignited the most powerful subsequent rallies in Bitcoin and risk assets. The creation of a centralized shorting mechanism for private credit confirms that the most sophisticated financial institutions on Wall Street are actively positioning for a systemic wave of corporate defaults. We have constructed a hyper-leveraged shadow banking ecosystem that grew from $40 billion to $3 trillion on the assumption that interest rates would remain near zero permanently, an assumption that the Federal Reserve shattered and has shown absolutely no urgency to restore. When the floating rate arithmetic becomes too brutal for these borrowers to survive, and the evidence overwhelmingly suggests that threshold has already been breached, the illusion of a private market stability will fracture in a way that forces institutional capital to flee from every asset class simultaneously. While the financial media celebrates resilient equity markets, the institutions behind the headlines are already purchasing fire insurance on the foundations of the underlying economy. But that's enough from me. So what do you think? Will the Federal Reserve pivot and cut rates aggressively enough to save the private credit market from a catastrophic wave of defaults, or is a 2008-style deleveraging event already unavoidable? Let me know your thoughts in the comments down below. And if you want to understand exactly how the United States government is altering the definition of inflation to obscure these structural risks from the public, you have to check out our deep dive video right over here. Thank you all so much for watching, and I'll see you again very soon. This is DC signing off.